Hello, everyone. This is Herb Strather, and I've just finished wrapping up our TV show concerning nonprofits and the tools you can use to become wealthy and develop the community. We also had on the show a wonderful gentleman by the name of Tom Hardiman, whose son, J&M Consulting, is recruiting people who want to be in the construction business, young men and women, I would suppose, between the age of 18 and 23, and I just want to tell you their number is 989-4141, 313-989-4141. What I'd like to do is to say a few more words about what I was discussing on our show concerning working with nonprofits. But just to review it, I suggested that the nonprofits, that you would form a nonprofit yourself. You go to EZ Forms, and you would get that nonprofit a 501c3 designation. And if it's a brand new nonprofit, it's a lot easier than trying to get a nonprofit that you've had around for 2 or 3 years through, because you got to provide tax returns, all kind of stuff. And it's easy to get a brand new one because you have nothing to really provide. You're new. And then once you get that nonprofit, you can go seek and buy real estate using bargain gift sales under Internal Revenue Code 170. Whereas you would have a portion of the real estate donated to you and a portion of the real estate given to you. Now, why would someone give a portion? Because there's usually a gap between what you can buy it for and what the market value is anyway. And what is the significance of the gap is that normally people will have to sell property based upon what their rent roll really is. But the rent roll is appraised, the property is appraised on what the market rents are. So they may be charging $600 rent, but the market is $700 for a 2-bedroom, for example. So you would have a significant increase in the market value of that property based on what the market rents are. The market value would increase because the market rents are much higher than the current rents. And you can leverage that difference. You can say, okay, I'll give you what you want, but there's blue sky over and above what you want. When I say blue sky, there's value over and above. Donate that value to me so I will not have to put a down payment. Because if someone sells you 80% and donate 20%, then you don't have a down payment. I further discussed the idea that once you get title to the property as a nonprofit, you do not have to pay any property taxes whatsoever. You become tax exempt. You have to make your application on the 8th floor of the city county building if you're in Detroit, or whatever municipality that you live in, period. In the United States, the same thing would be applicable. You have no taxes to pay if you are a nonprofit corporation by definition. And you can, a nonprofit corporation could own a LLC, 100% membership interest in an LLC, long as it owns 100%. It cannot own 99%. It has to be 100% ownership by nonprofit corporations or by churches, which is still a nonprofit corporation. It's either ecclesiastical corporation or just simply a nonprofit corporation. Ecclesiastical corporations does not have to have tax ID, 501c3 designations. A nonprofit, in order to get a bargain gift sale, you have to have a 501c3 designation. So either you're an ecclesiastical corporation or you are a nonprofit with a 501c3. Now, having said that, you can still participate yourself. If you are a licensed broker, or you got it made, you get fees and everything else when you make the deal that you can legitimately take out without harming or threatening the structure at all. Don't forget, IRS does look at these things, and they have the right to order their own appraisals. Remember that these appraisals are the most stringent appraisals of all appraisals. They have the most stringent rules, so I always suggest that you get 2 appraisals, because IRS can get their own. So it's better for you to have 2, especially if you have significant benefit. But if someone is going to finance the deal, for example, you're going to finance the deal, the donor can use your same appraiser. They just have to make it out, the appraisal out to them. So he'll make out 2 appraisals, one to the donor and one to your bank, the donee's bank. And if you use that appraisal and got financing, by definition, that would prove that it's worth that money. That would be evidence that it's worth that the appraisal is a good appraisal because you use it for financing purposes. And if an arm's length bank took that appraisal, then that strengthens you. So it gives you a wall of defense where IRS will not come. And when I say you, I'm talking about the donor. it gives the donor a wall of defense to make sure that the donor gets credit for the appraisal, that for the full value. Now, you can enhance that value once you own the property and it comes off the tax roll. Property taxes is usually about 10% of the gross income. So you can increase the property value about 20%, because if it's 10% of the gross income and operating expenses are 50%, this is a little complicated. If operating expenses are 50%, taxes are 10% of the gross income, then from the net income, that 10% becomes 20%, because there's 50% expenses. I know it gets a little confusing, but follow me here. Then you have a 20% increase in cash flow. You can use that for financing your property. So now you can borrow up to 95%, and that's where I want to go with you. 95%. Can you imagine borrowing 95%, 95%? And who would possibly loan you 95%? Here you go, friends. CDFIs, Community Development Financial Institutions. There are 6 of them in Detroit, and I want you to go look them up and find them and tell me who they are. I can tell you 3 of the good ones, and then I want you to send me the other 3. The first one to send me the other 3, I'm going to give you a free copy of my book. I give you 3. Which 3 I give you? Invest Detroit, IFF, and Capital Partners. Give me the other 3. I want you to look it up and find out what it is. And finally, this is a really last point I want to make, because I know that we're running out of time here, and I know you're enjoying this. If you may not be able to have any ownership of the LLC individually, but you could have a participating promissory note. You may have to sign as a guarantor to help the nonprofit get it, because some of the CDFIs want signatures, like, I won't tell you, okay, LIST, for example. They are a CDFI, and they want a signature. Where someone like IFF, for example, do not require personal recourse. When I say signature, I mean a guarantee. If you provide that service, you can get paid. How do you get paid? With a participating interest. It's not a fixed amount of interest. You just say, look, I get 20% of the cash flow from my services, for my guarantee, for my taking this risk, for my putting this deal together. In other words, you would subordinate what you would otherwise get, and you would take a piece of the cash flow, if any. And the cash flow is broad. It's cash flow, it's resale, it's insurance proceeds, it's condemnation proceeds, and when you sell it, it's even the sales proceeds. So it is truly an economic interest. It's not just the depreciation. You do not get the depreciation. You only get the depreciation if you own the equitable interest. I know that's a lot, but I want just to share that with you. And I thank you very much for being a part of the Mastermind Group. I want to give you what you need. And if there's something that you do not understand, I'm just a click away. And you each have my personal number, right? 313-407-4930. This is your coach. I love you, and let's go get them.